Hi, my name is Matt Carson. I've been trading stocks for several years and work a lot with options. And I just thought I would give a little video here kind of explaining what is implied volatility anyway. I think a lot of people hear the term but maybe don't really understand what it comes from or what it means. And I think you can understand a lot about options by understanding what implied volatility is. First, when you talk about what are the fundamentals of options, how are options priced? I think this is a very important thing to realize, because option prices are related to the stock price, but they're not coupled to it. This means that they're independently traded issues. They're not they're not set. There's no other mechanism that forces the option prices to change in a specific way. It means that they're set based on the supply and demand of the option and not based solely on the price of the stock. So I think this is about the most important factor we have here, is that they are independent of the stock price. So what factors affect the option prices? Well, obviously time, how much time you have until expiration, what the underlying stock price is, and the anticipated movement of the stock. So these affect option prices, but they don't determine the option price. Let's look at an example. I think this is the best way to really look at this and figure this out. So let's say that someone owns 100 shares of XYZ stock, which is currently at $100, and offers to sell you the option to buy those 100 shares at $95. So how much are you going to pay for that option? Well, obviously there's some things you need to know first. So you find out, you do some research, and you find out the stock was issued 10 years ago, and every share ever sold has traded at exactly $100. The price has never changed. So now you want to know, how much is this option worth? So how much are you willing to give? Well, the buyer and the seller both know that the stock could be sold for $100 at this instant. So if you buy and then exercise the option immediately, you'd make $5 because you'd buy it at $95 and sell it at $100. So this is the intrinsic value of the option. That's the intrinsic value, means that that's the amount that would be made if the option was exercised immediately after it was bought. That means that the call seller's not going to accept less than $5 per share, because that's how much it's worth to him. He can sell his shares immediately for that. So you could look at this as the intrinsic value will always be the minimum price that an option will be. So if we look at it from the buyer's side, you're going to look at the history of the stock and know that it's never been more than $100. So your chance of exercising the option to buy at $95 and selling it for more than $100 is almost zero. So you're not going to be willing to spend more than $5 a share either. So in this case, it's pretty simple. The option price agreed to between the buyer and the seller would have to be $5 per share or $500 per contract, because the seller's not going to go any less and the buyer's not going to go any more. Let's change the scenario a little bit. So let's say that all of a sudden the stock price of XYZ changed from a constant $100 and started to vary between $98 and $102. So now, how much are you willing to pay for the stock, or for the option to buy at $95? Sorry for my crude drawing here from Microsoft Paint. So let's see. So remember, the stock is still currently at $100. So this is a little bit more difficult to set the price. Perhaps the seller would be satisfied getting $6 per share. As he says, he gets an extra $1 per share profit over just selling his stock immediately. But if he thinks there's a chance the stock will go higher, he may want more. And the buyer's going to have to consider how much he thinks the stock will change to determine the worth of the option. If he thinks it'll go to $102 quickly, he might be willing to pay $6 or even $6.50. But if he thinks it's only going to $100.50 before the option expires, he's going to want to pay a whole lot less. So let's look at this definition. So in this scenario, the intrinsic value of the option is the same $5 as before. If you exercise the option, you can immediately buy the stock at $95 and then sell it at $100. But the additional value of the option above the intrinsic value, $1, if the option price is $6 in this instance, is known as the extrinsic value or the option premium. So what does this mean? It means in this scenario, the price of the option is something that is agreeable to both the buyer and a seller. In the real marketplace, this is set by a multitude of buyers and sellers, or in other words, it's determined by the marketplace. It's not going to be an individual. So this means that the stock price will be determined by how much the market thinks the stock price will change, or in other words, what the volatility of the stock will be. This is the option price will be determined, I should say. So in other words, the option premium implies what the marketplace thinks the volatility of the stock will be. The higher the premium, the more volatility the marketplace is implying. In other words, people think the stock is going to move more, so they value the option more highly because they think that the stock is going to be more volatile and there's more opportunity to make money, both as a buyer and a seller. The buyer thinks that if he buys the option now, that the stock will move enough to make up for the premium, and the seller thinks that that he's made enough money that he doesn't think it's going to move anymore. So it's kind of like an equilibrium point. So this brings this back. At the beginning we said that this option price is related to the stock price, but it's not coupled to it. So this is because the implied volatility is not related to the actual volatility of the stock. The actual volatility of the stock is how much the stock is varying now, but the implied volatility of the stock is how volatile the marketplace thinks that the stock will be in the future. So a good example of this is earnings time. The stock might not be moving much now, but the marketplace knows it's going to move at earnings one way or the other. And after it moves, it'll return to the lower actual volatility. So it's going to move, but then it's going to come back to the volatility is going to move, but then it's going to come back to be lower. So in this case, the implied volatility climbs during earnings because this is the expectation of future volatility, and then it falls again afterwards. And in addition, the collective knowledge of the marketplace sets the option premiums based on what option buyers and sellers agree is the expected movement of the stock on the earnings announcement. So this is why you can look at the price of the straddle coming into earnings and get an idea of how much the stock is likely to move. So now let's bring this back to look at some mathematics, and how do the Greeks figure this, or how does this figure into the Greeks, the implied volatility? People are of course always looking for statistical ways to describe stock and option price movements. Such models were created to try to describe the expected option premium of a particular option. So we have to look at what is known about options. An option with a longer time will obviously be worth more because there's more time for the stock price to move. An option with a strike farther into money will be worth more than an option with a strike out of the money. So the movement of option prices was studied, and then models were created to describe how this option price changed with regards to the stock price and the time. So they used what is observable, which is the time to expiration, or the stock price. So basically, what they did is they back solved from what happened with actual option prices and figured out a way to model this. One example is the Black-Scholes model you may have heard of. But the important thing to remember is that implied volatility is not observable. It's not fixed because it's set based on the supply demand of the option. So this is based on people's thoughts and people's the mindset of the marketplace. So this is not something that's observable. So one way to look at it, if the way this model is set up, is if the implied volatility of the stock stays the same, the option price will vary exactly based on the delta, gamma, and theta given by the model. So you want to say this. So if people think that the volatility of the stock is staying constant, then it will follow the model based on the other Greeks, the delta, gamma, and theta exactly. If, however, people think that the volatility will change, then it's not going to do exactly what you think is going to happen. In other words, maybe the stock price goes down, but the the call price goes up because people think it's going to move more. This wasn't a failure of the model. This was just that something that is outside of what the model can predict happened. It cannot predict exactly what people's mindsets are going to be. If the demand for the options had stayed the same, then based on the delta of the call option, the price would have dropped the correct amount. But if you look at that case, you'll always find that if the stock drops and the call prices go up, you'll find that the implied volatility has gone up. So let's look at some notes. So note that the implied volatility is calculated from the option model. So based on what the implied volatility has been, what the delta is, what the gamma and theta are, and the stock price relative to the strike and the timed expiration. So you solve the model using the actual option price and basically back solve through the model to get the implied volatility. So that when you look in Thinkorswim or something and you see implied volatility of the option is 40%, this was basically back solved through the model to find that, and then the other Greeks are then calculated. This is actually going to be, in mathematical terms, it's a partial differential equation. So this is going to be an iterative process to kind of come up with all of, the computers obviously can do this very quickly, but it is an iterative process in the computer to solve this model to find, okay, what's the current IV, the current delta, gamma, all these things. But the important thing to realize is that if you change the implied volatility, it does change all of the Greeks. I won't cover it in this presentation, but there's a whole lot you can learn by looking at how each Greek is affected by the implied volatility changes. I think the best way to do that is to look at a graph, perhaps of delta or gamma over stock price, and you can figure out and then look at what happens to that graph as the implied volatility changes, and you can really learn a lot. The last point I want to make here is, the option premium isn't really broken out into a theta part and a vega part and a delta part. This is kind of a mathematical way of looking at it. But if implied volatility is higher, then the premium is automatically higher. And it's always going to decay to zero at option expiration. The intrinsic value of the option will always stay what it is, but the extrinsic value, or the premium, is always going to decay to zero. So obviously if the IV goes higher and the premium goes higher, that means that the theta is going to go higher, because you still have to decay all of this premium away in X amount of days. So if you have the same amount of days but you have more premium to decay, obviously the theta is going to get higher and it's going to decay more every day. Let's say tomorrow, let's say it's an earnings day, and then so the IV drops, so the premium drops a whole lot at once. So it drops a whole lot more than theta. You can't really say this is a failure of the model. It's not like theta is supposed, if theta is 3 and it goes down 10, that 3 of that was for theta and 7 of it was for some other reason. It's just that the demand of the option got a lot lower because people know the stock's not going to move as much. So I think if you do all the calculations, because of the way the model is set up, you can kind of look at it that way, that there's a theta part and a vega part. But it's just important to remember all the time how these options are priced. And the most important thing to remember is that they are independently priced from the stock, and the implied volatility is a way of describing what is the demand for the option. What is the how much do people want this option? Obviously the more people want the option, the higher the price is going to be, just like the stock. If more people want to buy Apple, they think Apple's going to go higher, they're going to buy it. If more people think the option is going to go higher, they think that the stock is going to change a lot, then they're going to buy it. So implied volatility is just a way of describing the demand for the option. So thank you for listening. I hope that this was useful and helpful. Thanks.